And so we're going to continue a very similar discussion. Now, in the last paper, I think we looked at where the money went in Germany, substituting within the country. Now we're going outside the country, right, Kirsten? 25 minutes.
Okay. Yes, we will remain with the topic of mortgages, but we will go abroad. Okay, yeah. Thank you very much for including our paper in the conference. The paper is joint work with Lena Tonzer from the University of Magdeburg and the Halle Institute for Economic Research. Due to my affiliation with Deutsche Bundesbank, of course, the usual disclaimer applies. Well, what's our paper about? It's the title is Banks Foreign Homes, so you can already guess. Well, banks' international activities are, on the one hand, positive because they can facilitate diversification of risks, but on the other hand, they can also have negative associations because they can constitute as a spillover channel of shocks, of international shocks to the domestic banking system. So that's why we're interested in the foreign share of mortgages. On the other hand, just before interest rates increased in 2022 rapidly, banks have been operating in a low interest rate environment for quite some time, while mortgage markets boomed all over the euro area. Hence, we ask ourselves, has this maybe improved the attractiveness for banks to go into the real estate market? While, of course, there is already, okay, now I heard myself a bit better. Of course, there is already literature on domestic developments. However, the literature focused on domestic housing developments. Hence, we fill this gap and focus on foreign real estate activities of banks. And we will do this by focusing, this doesn't work, on this matter in connection with banks' search for yield behavior and bank country information advantages. Okay. In the interest of time, I will skip the literature and we'll come straight to our analysis. We will proceed in 2 steps. First, we assess in how far search for yield behavior drives banks into foreign real estate-backed lending. And I will keep this very bulky term of real estate-backed lending because later on we will distinguish between residential and commercial real estate-backed lending. That's why we have, that's because we have this very nice bilateral data structure which provides us with this kind of information. In our analysis, we also account for macroprudential regulation, and in a second step, we focus also on the implication for bank stability. Our sample spans the significant institutions of the SSM, which are roughly 80% of the banking assets in the SSM, so we have a significant share. And we make use of the supervisory reporting framework data, FinRep mostly, which provides a geographical breakdown of the asset and liabilities of the SIs. Hence, we know how many real estate-backed loans Deutsche Bank holds in Italy or in France. And we know this for all the SIs, which is very nice because like this, we have country level information by bank. And as I already mentioned, we also have this kind of information by commercial real estate and residential real estate backed loans. Hence, we can distinguish here, and this is while we do not have such granular data as AnaCredit, for example. This is the benefit compared to AnaCredit, because this under credit only contains commercial real estate-backed lending. We will focus on the intensive margin and not include any extensive effects. And we complement our data with income and balance sheet information, also from the supervisory reporting framework, but on the bank level. And we also use country-level information from ECB, Eurostat, and OECD, for example, the lending rates. Some stylized facts, so if you also believe me that it's of relevance. This shows the real estate-backed loans on the bank's balance sheet, sorry, and it's distinguished between commercial and residential. It spans for our sample period, and as you can see, there is like a slight increase. However, this is mostly due to an increase in central bank reserves, and these are included in the share in the total loans. That's why they have an effect here. Okay, there is quite a large share, around 30 to 40%, and residential is more important. It makes up 2/3 of the real estate-backed lending. This is pretty much the same graph, but only for the domestic and the foreign real estate-backed lending. And here you can see about 1/3 is for foreign real estate-backed lending, and half of it is actually from the euro area. Okay, our empirical approach is pretty straightforward, I think. The dependent variable is the foreign real estate-backed loan share divided by the total real estate-backed loans by the bank, and the variable is on the bank country level, as I said. Our identifying assumption is that the reaction to the lending spread depends on the ex-ante exposure of the bank to the destination country. Hence, if the bank is active in the destination country prior, we assume that it's more responsive to a higher lending spread. And with the lending spread, we measure the bank's search for yield behavior. We calculate the lending spread as the difference of the destination country lending rate with the home country lending rate. So for the individual bank, we assume this is to be exogenous. We include a couple of bank controls and also bank fixed effects, time fixed effects, and to call for control for demand effects, we also include country time fixed effects, which we can do because of the data structure. Okay, I mean, I think you're familiar with mortgages. However, mortgages are loans which are secured by real estate. So let's go to the results. As you can see, as a measure for the ex-ante exposure in the destination country, we use the non-financial deposit share for the commercial real estate, for the commercial real estate-backed lending. And as you can see, we have a positive interaction effect. However, when we use an alternative measures, for example, a more direct measure like the NFC loans to the real estate sector, also on the bank country level, we do not find a significant effect. However, when we do the same for the construction sector, we again find a positive and significant interaction effect. To use like a more negative experience indicator, we also try our regression model with the NPL ratio of the commercial real estate backed loans. And here we do not find a significant effect. However, this is our main specification, and we will go on with it. It, from our point of view, does indicate that there is something happening. And in the interest of time, I'm not showing you the results for the residential real estate. However, here we also find a positive and significant effect, which, however, is a bit weaker. I forgot something. In economic terms, this is about 14% of the average share of foreign commercial real estate-backed lending, given the average deposit share and one standard deviation of the lending spread, which is 84 basis points. Yeah, we also have a couple of robustness tests. For example, we take the average of over the last 4 quarters to also reduce for simultaneity concerns. We run a horse race with a house price spread to control also for the house price effect. And we check for sub-periods. So far, I mean, our results are not super surprising. And however, as the financial crisis has shown, macroprudential regulation is not sufficient to maintain financial stability. However, we have introduced several macroprudential regulations, so it's worth to have a look. And since they are also real estate specific, we use the macroprudential measure database provided by the European Systemic Risk Board to identify national macroprudential measures specific to the residential and the commercial real estate. And based on this information, we construct dummies on the presence of these regulations. And based on these dummies, we construct subsets and repeat our estimations. And here, as you can see, column 1 is our baseline result, and column 2, 3, 4, and 5 show you the results for the subsets. And maybe we go directly to column 3, which shows you the results when there is a macroprudential regulation for the commercial real estate present at home, but not in the foreign country, the destination country. And as you can see, here we find that this positive interaction effect, as well as when there is no macroprudential regulation in place at home and not in the foreign country. This is like aggregated for all commercial real estate connected regulation. However, we also repeat this distinguishing between the macroprudential measures, for example, loan-to-value ratio, risk weights, and so on. And we, of course, also do this for the residential real estate, and we find the same effects. What kind of financial stability implication has this? Because, I mean, a lending rate or a larger lending rate is not necessarily only due to a higher return. It's also associated with higher risk. Hence, we also look at the financial stability implications by considering 3 different bank stability measures. For one, again, we are still on this bank country level. We use the forbearance ratio, the accumulated impairment ratio, and the NPL ratio as a dependent variable. And maybe because the 2 of the measures are not so familiar, let me explain them. The forbearance ratio is the ratio of loans under so-called forbearance measures. These forbearance measures are, for example, when the term of loans are modified, when the interest rates are repriced, for example. However, this can not only be done randomly or decided randomly by the bank. The bank has to have credible doubt on the stability of the loan to actually apply these measures. And the nice part of this measure is also that it's not only about the non-performing part of the loan portfolio, but it's on both. It's on the non-performing and the performing loans. The accumulated impairment ratio is the accumulated impairment to the gross carrying amount of real estate-backed loans. And again, this is not only on the non-performing, but also on the performing parts of the loan portfolio. I think NPL ratio is familiar to you. Again, we use the same regression model as before. And but now, of course, we can use the lagged share from real estate-backed loans as the exposure measure. Because there have been a lot of measures, especially from the supervision, but also from the regulators, in connection with loan provision and so on during COVID. We directly distinguish or split our sample period in pre-COVID and post-COVID. And however, this actually doesn't matter that much because we do not find a lot. And this is actually also, this can also be explained by our sample period, which spans from 2015 to 2022. However, the interest rates increased in July 2022, and our sample goes until the third quarter. Hence, to find some more effects, I guess we would have to increase our sample period. But for now, our results are pretty much dependent on not only splitting the sample periods, but also accounting for the capitalization of the banks. So we find for commercial real estate-backed loans that only better capitalized banks report a higher forbearance ratio in response to the larger ex-ante exposure to a country with a higher lending rate. And for the real estate-backed loans, we find that in connection with a higher lending spread and country exposure, that a higher NPL ratio for less capitalized banks is only for during COVID and the post-COVID period. We also aggregate all these bank country-specific measures up to the bank level. And here we actually find very similar results. To let me sum up, we find evidence that banks with stronger ex-ante links to foreign countries expand real estate-backed lending in response to higher lending rates compared to the home country. And these effects we find especially given a lack or a misalignment in macroprudential policies across home and the destination country. And this is actually what makes it very interesting, because it shows that the macroprudential policies have an effect on banks' decisions in terms of loans or where they allocate their loans. And also carries the policy implication, because it highlights the importance of the harmonization of macroprudential policies, because this does not work as intended if national regulators apply these policies differently or different in the intensity. And our last result is also like that we do not find a lot, but for the risk implication that we find that the effect depends on capitalization, which could indicate that less capitalized banks insufficiently manage their risk in terms of real estate-backed lending.
Thank you so much. Iñaki Aldasoro from the BIS will discuss the paper. 10 minutes, please. You even have a minute more.
Thank you.
If you wish to.
Hopefully not, and congratulations to all of you for staying stoically until the end. And happy birthday to the FSR for its 20th anniversary. And let me thank the organizers for giving me the chance to discuss this very interesting paper, and also giving me the chance to come back to Frankfurt, which is also always very nice for me. Now, before I begin, let me just remind you that this, whatever I say now is my views and not the views of the BIS. So let me start by giving you a bit of a run of my reading of the paper. Now, Kirsten mentioned the name, and it was maybe like an obvious what the paper was about. Actually, when I saw the name, and probably because of my background working in this space, I thought like, oh, it's a paper about subs and branches and basically how banks set up shop abroad. But it's actually not. It's basically about the foreign state real back lending. So I guess it's not. Or should I point it there? Yeah, there we go. Okay, there we go. So it's not at all about subs and branches, or not necessarily specifically about those. It's about the foreign real estate back lending. So to fix ideas, let's try to think about a German bank that has operations in Germany, has operations in Spain, and has also affiliates as well elsewhere in the euro area and elsewhere in outside of the euro area. And think also about non-financial corporates, so non-financial agents, basically, in non-financial borrowers in Spain that may want to borrow against real estate, either commercial or residential. So how would the German bank go about lending to these borrowers? So one option is, of course, direct lending through the local affiliate in Madrid. But then, of course, as we know that the largest operations of banks tend to be in their home countries, and another option, of course, is to do this cross-border, directly cross-border from the German office here, somewhere close by in the neighborhood. But then, of course, this German bank can also lend this from cross-border from other locations. It can do so within the euro area, from affiliates elsewhere. It can also do so outside of the euro area. Now, this is only direct lending, and things then, of course, can get a bit more complicated. So bear with me for a second, because there can be, reallocation of funds between the conglomerate to basically move funds around to ultimately fund the Spanish borrowers the borrowers in Spain. Now, this is as far as I would get it. It can get even more complicated, but this, I think, gives me enough to paint an idea for my reading of the paper and what the paper is doing. So what the paper is doing is effectively focusing on a subset of these red lines of direct lending. And I say a subset because the lending could be, and doesn't need to be necessarily real estate back. It could be much more, no? But they focus on the real estate back portion of it, and they do so from a consolidated point of view, which means that they cannot distinguish between the different arrows, right? So this is all going to be aggregated into one. Now, in terms of regression, what the main regression, which kind of then has some variations through the rest of the paper, is they look at the lending of the German bank from a consolidated point of view to the Spanish borrowers, and they study this as a function of this interest rate differential, which is a lending spread between the lending rate that you can get in Spain and the lending rate that you can get in Germany, and the kind of the expertise in the foreign market, which is most of the time a deposit share. So the deposit share of, say, Deutsche Bank in Spain, relative to the total. And of course, they're gonna do this, as Kirsten said, they're gonna do this for commercial real estate and for residential real estate, and they're gonna be adjusting the rates and the deposit shares and the lending accordingly. So they are they're doing a very thorough thing there. And based on this, basically, they have two main findings. At least two main positive findings, and there was the kind of the last bit which there is less findings. So Number one is that they have evidence that the estimate of beta is bigger than 0, meaning banks expand the share of foreign real estate-backed lending when the interest rates, when these lending spreads are higher, and when this expertise is higher. And this is particularly the case for commercial real estate, less so for residential real estate. And then this is stronger if the home country, so Germany, has the macro-pru quote-unquote on, and the destination country has it like quote-unquote off. Now, most of my comments would be about the blue stuff, the green stuff, and a bit about the macro-pru, which also relates to the red stuff. But before I go into the specific comments, let me give you a bit more background, some on the paper and some from my own. So I got excited about when I started looking at the paper and the stats, and I said, like, I'm just going to go to the locational banking statistics of the BIS by nationality and explore to get a feeling for what these arrows may look like. So in terms of the paper, just to give some perspective, so for every 100 euro of lending, they show that 31 are going to be backed by real estate, of which about a third will be foreign, of which in turn about half would be euro area, and of which is going to be split roughly 2/3 residential, 1/3 commercial real estate. So at the end of the day, it's about 3 euros of residential and 1.5 of commercial. Might look small. It's not really small, not least in light of the comment that I think Livio made yesterday about the importance of housing markets for financial stability. Now, in terms of the banking statistics, so what I did is I looked at the euro area headquarter banks. They're lending to borrowers in the euro area, and how much of that is local, how much of that is cross-border. So I focus only on non-financial corporates and households as borrowers. And as you can see from the left-hand panel, most lending is actually local, so meaning done by an institution that is resident in the same country as the borrower, whatever its nationality in principle. And the cross-border part is mostly within the euro area. And the right-hand panel shows you that portion of cross-border is actually mostly in euros. Moreover, across locations, so if you think Austria, Belgium, Cyprus, Germany, Spain, and so on, in each of these locations, most of the local lending to households and non-financial corporations is going to be done by home country banks. So in Spain, it's going to be mostly Spanish banks. In Germany, it's going to be mostly German banks. And I'm plotting those shares there. And then from the perspective of the banks themselves and their local lending in the euro area, is going to be done mostly at home. So with this out of the way, let me go into the comments in terms of the lending spreads. So I think Kirsten already hinted a bit at that when she presented the risk results towards the end. So the way I see it, the profit maximizing banks should be actually lending where rates are higher, adjusted for risk. And the fact that, in the risk analysis, financial stability analysis, in the third part of the paper, or in the latter part of the paper, has very little positive results, speaks to me in favor of the notion that actually they are not taking too much risk. So one suggestion that I would give is that you actually spin the results in the latter part of the paper, and you link them to this issue of risk adjusted versus not risk adjusted. So that's one comment on the lending spreads. Another comment is what is the right price, right? And an obvious comment that emerges as one starts reading the paper is the distinction between spreads between housing prices and the lending spreads that are being used in the paper, and how would results look like if instead of the lending spreads you just have the housing pricing spreads. Now, to be fair, there is a current robustness test that is going in this direction, but at least in the version that I saw, I think it's not enough because it's using residential real estate with vis-a-vis NFC shares, and I think this kind of potentially runs into a bit of an apples and oranges issue. So here a suggestion is to match more carefully in that particular part of the analysis residential real estate with household borrowing, commercial real estate with NFC borrowing, and also use the price spreads as controls. It would be great to see those in the regressions as well as controls, rather than just as a plain horse race to ensure that the results still go through. Okay, not moving now. Oh, there we go. So comments on deposit shares. So I have a couple of comments as well on this measure of expertise, which by and large is deposit shares. First question is basically what is expertise in the context of real estate lending, where collateral plays a much more prominent role than collection of information in other type of lending. And here you acknowledge this in the text where you say it should depend mostly on lending rates and collateral value. But then you kind of quickly disregard this, the collateral aspect of it, under the premise that in a low interest rate environment, then the search for yield is going to trump everything else. But again, I come back to maybe the point that I made in the previous slide, that, you know, a bank that, I mean, as far as I'm concerned, banks are always searching for yield. And a bank that is not searching for yield is actually not a banker that is not doing this. It's not doing its job. So a suggestion on this respect is to also think about incorporating prices potentially as proxies for collateral if you decide not to do it in the way that I suggested in the previous one. And the second one is what is expertise in terms of the presence in the foreign country. And here I wonder whether the deposit share is the right measure. The deposit share, NFC or households is the right measure. What I'm doing here is I'm plotting again, using the example of German banks, I plot the euro area liabilities of German banks by booking locations. So these are liabilities vis-a-vis households and non-financial corporations, by booking location and by position type, meaning cross-border versus local. And I also plot the line there just for good measure. I mean, you can see it's basically all local booked in Germany. So the share that is booked in Spain is really negligible. So here a suggestion is to come up maybe with other measures. One that came to mind, but I'm not particularly married to it, is use the assets in the host country, meaning in Spain, as a share of the non-home, so meaning excluding Germany, but within euro area assets, right? So you look at the foreign perspective from a German bank, foreign vis-a-vis the euro area, and then you look measures of expertise by looking at the share of each specific location. Now, in terms of macro-pru, this is where I think the use of consolidated data may come back to bite you a bit, because you do not know where the lending is done. Although the previous graph that I show from the locational banking statistics by nationality hopefully paid a bit of a picture. Now, in your main result, we see that if Germany tightens and Spain does not, so that's kind of the most robust result on the macro-pru side, then the German bank will lend more to the Spanish borrower, again in a relative sense because you look at shares in your main analysis. But we've seen that most lending is local, so maybe I'm getting confused, but I wonder whether this actually should be the other way around, and at the minimum, why should home play such a strong role here? So because if Germany tightens, then it will apply to banks operating in Germany, which will include the foreign subs of other banks, but from other nationalities, but it need not apply to the German bank sub in Madrid without reciprocation. So here a suggestion is that you have data on reciprocation of macro-pru measures from the ESRB as well, which is the main data set that you use. So a suggestion is to actually exploit this reciprocity data to refine this part of the analysis. So I have other comments. So let me just mention this one from the independent variable. I think it would be really nice to also see amounts, quantities, and not just the shares, because otherwise, I mean, what is special about the real estate? I would expect to see this the same for non-real estate back lending. You know, so to try to get a bit about what is special about this. I have some other comments, but I could relay those bilaterally. So let me wrap up. I really enjoy a lot reading the paper. I learned a great deal about the data and about foreign lending, and I strongly recommend that you read it too. Let me close with the quotes from my fellow countryman, Jorge Luis Borges, which says that the concept of a definitive text belongs only to religion or exhaustion. I use this as an opening line of my dissertation. We are not writing religion script here. You know, obviously, I was very exhausted at the end of my dissertation. I hope you're not exhausted by the paper so far, because I really hope to read the next iteration. So thanks a lot for your time and attention.
Okay, thank you very much. We have some time for our last floor discussion. How is our online audience doing? Did it leave for drinks already, or is it none? Oh, okay. So one per day is better than none per day. Okay, who has still some energy left? Stein, come on, give an example to everybody.
It's more clarification. So the macroprudential is important, but is it the supply? I mean, a macroprudential tool that's being applied to the bank balance sheet, or is it demand an LTV that's applied to the borrower? I assume, since it's the ESRB data, that is more the former is, but that's going to make a difference, of course, in terms of what you would expect. So can you tell me what you did?
A quick thing that I may have missed. When banks land outside of the euro area, can you observe whether they land in euros or in local currency? I think that could be like an interesting dimension. And it was an issue a few years ago, I mean, especially in Eastern European countries, if I remember correctly.
You want to go? There's no other question.
First of all, thank you very much for this very great discussion. Let me answer a few, answer to a few comments. First of all, thank you very much. Risk-adjusted returns are actually a very nice idea. I think the issue is to measure the risk on the country level for these kind of loans. I think here we would need like a uniform measure for all euro area countries. And that's something I forgot to mention. We focus also in terms of the destination countries only on the euro area. And of course, this is nice because like this, we have a uniform monetary policy and we not have to account for it. And we also have like a uniform source of data, which is the lending rate, which are the lending rates. We use the cost of borrowing indicator of ECB, which also accounts for differences in the terms of lending, because some countries have a greater share in short-term rates applied to loans, to the real estate loans, compared to Germany, which has like a longer term. The right price. Here we have like a data issue. The thing about residential real estate data, we don't have it, especially not on the country level. We would have liked to do this, but weren't able so far. But of course, that's something we could at least try again. In terms of the deposit shares, actually, like for the NFCs, I'm from the banking supervision department of Deutsche Bundesbank, so I also know that for banks providing loans to NFCs, they actually ask banks to make them their home bank, so that the NFC also provides information by giving them information on how much funds come to the bank, leave the bank, and so on. So I do think that the deposit share also for NFCs is actually a pretty good measure for expertise in this sector. However, yes, of course, we can improve this here. In terms of the collateral value, our argumentation was here that since we are interested in the lending spread, the collateral value only matters for the bank when the loan defaults. And as long as the economy is going good, the bank actually does not expect it to default so much. And also from a banking supervision view, you also expect the bank to account in a booming phase that there might be some aspect in the price which is not consistent, not over the long term. Hence, banks have to account for this. So at some point, the price is no longer that of high importance for the bank, at least in valuing the bank, valuing the loan as the real estate as collateral. You have to take like a bigger haircut in a way. And in terms of the supplier demand in connection with the macroprudential policy, I think it's both. Because for the macroprudential policy, we have borrower-based measures, which are directly connected to the borrower. But on the other hand, there are also risk weights. And of course, this is more from the supply side. And as I've mentioned, since we are only considering the euro area, we do not care so much for the currency. But yeah, thanks.
Okay, thank you very much. So let me conclude this session by recalling, so we have had a deep look at some of the side effects that monetary policies can have. But let's not forget, euro area monetary policy is euro area wide, not specific to some country. That doesn't mean that the effects are the same across all the countries, obviously. Second, the first line of defense is always the prudential policy in what regards side effects of financials of a supervisory or financial stability nature. And to the extent that that may not be fully effective, we have our proportionality assessment of monetary policy measures that would take those side effects into account in the calibration of the different measures. Let's give a hand to the last two authors for this session before I conclude the conference, perhaps. So we had a very impressive 2 days, actually. So the last 2 days. So first, the FSR, the Financial Stability Review of the ECB, was released. Second, there was a high-level policy forum yesterday afternoon celebrating the 20th year of the Financial Stability Review of the produced by our Financial Stability Macroprudential Policy Department. Today we had this wonderful research day. So going back to the high-level forum, there were 2 parts: one on communication issues in releasing financial stability reviews, another one on the analysis backing up financial stability reviews. I recall 3 messages. There were more than that, obviously, but 3 stuck to me. First of all, there's this perennial issue of warnings, like how much do you warn and how do you assess type 1, type 2 errors in warnings about risk. And so I sensed a little bit that there was the discussion made the point that one had to, in the case of doubt, err on the side of warning one more too often than one time too little. And second, actually, that there's actually evidence, Stein mentioned that in his intervention yesterday, that actually warnings can be effective in reducing risks or have some predictive power in terms of crisis or distress situations. And then there was my third point from yesterday is that there was a very interesting discussion about the interaction, like the session, the topic of the last session we just had here, the interaction between monetary policy and financial stability matters. And there was a diverse discussion about the leaning against the wind debate, the old debate that some of you may remember. So actually, I don't think it was ultimately concluding. People held different views in this regard, whether sometimes monetary policy needs to either lean or take into account the financial stability effects and maybe be a bit less strong than it otherwise would be in certain circumstances. Today was split in 3 parts. The first part was about structural developments in banking and non-banking sectors and their financial stability implications. The second part on prudential policies, like which policies could do something about some of these financial stability implications, and third about the interactions with other policies, and this time mainly monetary policies. So in the first part, Moritz reminded us of the importance of large banks in financial or systemic crisis, and how this is very visible in history, although this may be less pronounced going forward, given the structural changes in the financial system. Then we learned about other structural changes in banking system right now, like how the digitalization trends actually change the deposit behavior, like the deposit remuneration behavior of banks, and how this has macroeconomic and financial stability implications, or how the private debt market is growing at a very fast rate in the US and what that implies for the stability of the system. Then we heard about risks outside the banking sector, as more pronounced outside the banking sector, how there can be a differential effect of liquidity risk as compared to solvency risk, as experienced in the LDI crisis in the UK. Then on the policy side, there was a very interesting contribution on payout restrictions. Actually, we had also ECB work on this. Actually, the ECB work, sorry for this parenthesis, but I remember it very strong, is that actually there was some evidence in the euro area that actually the dividend guidance that the single supervisory mechanism gave actually led to the effect that the lending of the affected banks was stronger than by the non-affected banks. So there was, in this difficult situation of the COVID pandemic, there was this effect that this actually helped retaining some lending. Parenthesis closed. Then we heard about one of the key policy issues of today in the prudential area is like about this positive neutral countercyclical capital buffer and how you make sure that when you have to release the capital buffer, actually there's something to be released. Very important at present. And then we heard now the last session about the interactions, how the transmission can be affected through so-called zombie firms, how a corporate sector purchase program could have effects on real estate valuations and financial stability, and lately how the lending abroad would be affected, for example, by a low interest rate period. So this is what we have done. I think it was very interesting 2 days from the start, from our FSR until the last discussion. This last day, the research day, has been organized jointly by our Director General, Macroprudential Policy and Financial Stability, together with the research department. I'm from the research department. The organizers should be thanked. Livio Stracca, whom you have seen, Angela Madaloni, those who are still here can feel free to stand up. Marcus Behn, who kept awake some of the online audience, and Sandor Gardo, who I'm actually not sure he's still here. But we shouldn't also forget the logistical support. Felicia Dickmeis has, for example, kept the IT going there on my right, on your left, but also Stefan Seitz, who organizes this logistics very nicely, Nicolina Mihilli, Christine Wehrheim, and many other colleagues who I may not even know what they do in the background. This was not the last edition of the Financial Stability and Macroprudential Policy Conference. Next year, you can already mark in your calendar, 10-11 June will be the next one. And that time, it will be shared with the Federal Reserve Bank of New York. There will be one day joined with the Federal Reserve Bank of New York, which I'm sure will be very exciting. That's all what I have to say. I wish you a nice trip home and safe, and hope to see you next year. Thank you.